All right, so I wanted to talk about just kind of introductions a little bit for those of you that don't know who Elevated, who we are and what we do. Kind of wanted to give a screenshot of of who we are and what we do. So we are based in the Dallas, Texas area. Myself and George both live here in Dallas. We've been here for about 15 years, originally from Miami, Florida. But our company is based here, and we own properties in multiple states. 1, 2, 3, 4, 5, 6, 7 states, as you can see, dictated here by these pins. We've acquired over 6,000 units, have sold some properties, which is great. We've been in the multifamily business for about almost 4.5, 5 years now. We've been blessed to go full cycle on about 1,400 deals, and we've raised close to $100 million in equity already. It's crazy to think of, when we were buying our first property, in Temple, Texas, it was just 37 units for like, $1.5 million. And, now we're buying properties like the Porte, Texas today that are $75 million purchases, Class A buildings. So we've come a long way. And it's exciting for all of us. We're all about doing good business and delivering good returns for all of our investors, and we're happy that you're here. So as of right now, we have about 350 investors that currently invest in our network. We try our best to communicate with, as best as possible with all of our investors, whether it be, when we're closing, throughout the, asset management process, and then even on the disposition phase. So our investor base is growing every single day, and we hope that, by the end of this presentation, you'll be joining us on this, on this project, and, you'll become one of our investors as well. And then, obviously kind of the biggest number is, we have about, the portfolio is about $400 million under management right now. So, a lot going on for us in the last 5 years. I can tell you that we work 24 hours a day, 7 days a week over here. We don't sleep. We're working tirelessly to find deals, to deliver good returns to our investors, and ultimately do good business. So, we're excited about that, and again, happy to have you here. So here are some examples of just, some of the things that we've done in the past. This is a deal that we bought in Augusta, Georgia last year. It was called Fairway Village when we bought it. And, we rebranded it, named it Green Meadows Apartments. And we were able to do this in only a year's time. Which is crazy, right? The market is pretty hot right now, and not every deal will be this way, right? Most of our deals are projected on a 3 to 5 year hold, but we were, lucky enough to execute our game plan and our business plan, quickly and efficiently, and then take advantage of the market and then be able to sell. So just a couple highlights here. We paid $55,000 a unit. I'm not sure if you all can see my mouse, but we paid $55,000 a unit, bought it in February of 2021. And then sold it in March of 2022, so avoided short-term capital gains. Our projected returns were a 19% IRR with a 2.1% equity multiple, and we were able to actually hit, and that was over a 5-year term, right? So we were actually able to hit our realized returns were 110% IRR in a year's time, which is wild, right? And we hit a 2.1x equity multiple. So all our investors were very happy on that deal. Everyone got significant depreciation benefits. We originally underwrote this deal at an exit value of about $104,000 a year, a unit over 5 years. And again, we're able to realize that in about a year. So super successful, super proud of this deal. Some of our investors that were in this deal may be on this call tonight. So we appreciate you guys again for sticking with us and believing in us. And we just appreciate your continued support. So, again, this was a great one. So I want to talk about just one more deal, and then we'll kind of get into, the deal itself, Domains at Morgan's Landing. But this is another deal that we bought last year, December 2021. It's called Lone Oak Apartments. It's here in the DFW area. It's in Weatherford, Texas, actually. So it actually, I think that's a typo. It was actually built in 2020 is when they got the CO. But anyway, we bought this deal for $198,000 a unit. When we bought this deal, we were at a pretty low basis. We've been, implementing our value add plan, now continuing to raise rents where possible. Our lease trade outs have been very, very successful. and implementing small things that will, basically elevate the quality of the life for the tenants, and hence why they want to pay more rent to be able to live at this apartment complex. So anyway, this is actually really exciting, and I guess we're announcing this for the first time right now to everybody, but we are going to be we're preparing to sell this property in just a year at $260,000 a unit. And again, right place, right time. We bought it at a low basis. We've been, doing the right things from a management perspective, and now we're coming in and putting it on the market and selling it for $260,000 a door. So our projected IRR is 20% and a 2x equity multiple within just a year's time, right? So again, not every deal is going to go like this. Most deals are 3 to 5 year holds, but we wanted to share some of our successes with you guys. This is something that we're very proud of, and just goes to show that we're buying good deals, and we're producing on our end in a positive manner.
Projected returns, Eric, by the way, are way lower than it's going to actually be. I mean, it's going to be 200 plus.
Yes, correct. Yeah, the returns are going to be blown out of the water, which is great. So anyway, that's just kind of an introduction about who we are and what we do. I'm going to be passing the baton, if you will, we're going to be passing the baton to the different team members. So I'm going to let Brian take it away now, and he's going to be talking about the property itself and digging in with the property overview.
Yeah. So as Eric mentioned, we're looking, this Lone Oak apartment case study really highlights our acceptance of this A-class property. So 5 years ago, you may have asked us what we're looking at and may have said, we're only buying value add, C-class, B-class properties. But with the way cap rates are compressing, the more demand for an A-class unit, for more people looking to stay in a place to rent versus buying a home. You have more people wanting these high-end amenities, the white-collar workforce working from home with a place that has amenities. So really happy to jump into Morgan's Landing with you guys here. So as you can see, a good indicator of an A-class deal is a year it's built. So built just last year, just finished building in 2021. Large property, over 300,000 square feet. We're right at 350 units on this property. So great economies of scale here. Effective rent right now is around $1,450. So there's Justin Gooden. We'll go into that after George talks a little bit about the market, but there's definitely some opportunity there. Great asset that we are buying directly from the developer who's gotten it up to 95% at this current time. Best in class product. Some of these major bullet points you might have seen earlier that we released, but this is really a great product, a great builder there in this Morgan's Landing area. It definitely sets a standard for the A-class properties. There's very limited inventory in this area. So limited single family inventory. You see there only 3 homes available in the adjacent neighborhood. So you talk about this housing crunch that we're currently in, and people looking to buy homes and necessarily don't have the right place to buy a home. This is the type of asset that your potential high income earner is living in until they find a place to live. Close to the Bay Port. George will be talking a little bit about that too, but great area in La Porte, Texas. If you're familiar with Houston, the Port of Houston is right there in the Bay Port, La Porte area. Very high wages in this submarket of Houston.
You're stealing my thunder, Brian. You're stealing my thunder.
Yeah, so George will dial in on this. Just some of the highlights here. I'll go into our projected return. So 5-year hold, as you know, we generally model out about 5 years for these investments. As you see with the case study that Eric had, Lone Oak, if we see an opportunity to double that equity or get close to that's usually an indicator we might pull. Just depends where we are at in the market, but we definitely want to say 5-year hold to account for any market cycles. 4 to 6% average cash on cash return as we work on getting the rents up and getting some of those expenses down. You'll see a lower cash on cash return, but this really has a high upside in that equity multiple. 70-30 split until we reach 18% IRR hurdle. Then it's a 50-50 split. Before that 70-30, there is a cumulative 6% preferred return. So that's meaning before the managers get paid, that you as the investors, or the LP, are getting your 6% portion before that 70-30 split. Go into a quick overview of the property here, some of the amenities, apartment features. Spoke about it a little bit here. It's in LaPorte, 35,000 residents in the LaPorte area. Some of the amenities we actually had, this was about 3 pages of amenities. I mean, it's an awesome facility, especially if you're ever in the area. Definitely welcome you to go check it out. But we condensed this to 1 page just for your guys' time's sake. But there is a ton of nice amenities on here, including storage. You can see the beer garden area for residents to hang out in. Some a very nice, some of the pictures you've seen, very nice pool area, which in Houston, it can get pretty hot. So definitely a nice facility to have there. Little arcade, business center area, mail drop area, and even a TV room.
Actually, real quick, Brian, just to jump in there, one of the coolest things that I thought that this property had, well, obviously the beer garden on the bottom. I mean, who doesn't like that, just to kind of hang out? But this property had a car wash, actually, which is really convenient for the residents, right? I mean, I haven't seen that yet. I wish the apartment building I live in a Class A building here in Dallas, and we don't have a car wash. I mean, that's pretty convenient. So I thought that was pretty cool. I haven't seen too many properties with that, so something pretty interesting. So I just wanted to highlight that real quick.
Yeah, definitely setting the precedent. You can tell this is a 2021 build in this area. So having that extra edge, like a private car wash and the dog wash stations as well. So it's definitely nice amenities to have there. George, are you going into location, or where do we have you picking up at?
Yeah, right there. Let me catch up on my side. There we go. Yeah,
so I touched on it briefly about the awesome location, but George is going to take it over from here and really dial in on the market, some of the other aspects.
Yeah, thank you, Brian. So location, right? I was the first one to go out there and tour this property. We looked at it, we looked at the numbers, everything looked really good. So on one of my several trips to Houston, we've got a lot of properties down there, so I'm always back and forth. I took a look at the property, and we weren't sure about the location, to be honest with you guys. We don't know. We own a lot in Houston, but we don't know anything by the port, and I hadn't really spent much time down there, so wasn't sure what to expect. But the second I stepped foot on property, I was speechless. Like, I've done a lot of construction work on Class A stuff. We own several Class A properties, but this one truly to me is an A+. Like, the amenities it has, I don't know if you saw that massive list that Brian was going through. But yeah, it took me back. And then if you look at the pictures here on the screen, so Domain is there in the yellow. And these homes right here, doesn't look like it in this aerial shot, but these are $500,000 to $1 million homes sitting right behind it. And really, anybody that works in the port or in the chemical plants nearby, which I'll get to that in a second, there's a ton of jobs there. They all make pretty good money. And then this is where they go to live, because directly around the plants, there's more C-class properties. There's not a lot of A-class properties. So that was the first thing I noticed, even walking and touring the units during DD, just very well taken care of. And then, so like Brian mentioned, this is in Porte, right, which is right by Bayport, as you see here. And then you've got all these major chemical plants and oil. You got NASA not too far away as well. Over here, you just see some of the retail shops around the property as well. And then here, I wanted to pinpoint or point out, when I said, higher salaries, you can see here, your average household income is 112,000. And then income by age, if you look at the 45 to 54-year-olds, they're at 119,000. So pretty high salaries, definitely much higher than your average income. Which what that does in turn, it gives us more space to charge amenity fees if we need to, or bump up the rents, like we're going to be doing here, and doing a second phase of. So essentially, the where we found this little niche with A-class properties is a lot of developers aren't operators. They just want to build it, they want to fill it up and get rid of it. They don't want to be operating it. So if we come in right behind them and either take it during lease up or right when it's done with lease up, there's a whole other phase of leasing that we get to get in on, and we can really push those rents, because all they were worried about was occupying it. Now it's occupied. We get to see where we can push those rents and add value to the properties that way.
Which is exactly what we did in our Lone Oak Apartments case study, and that's why we're selling it for $260,000 a door now, because we bought it straight from the developer. They had lower rents coming in just to get it leased up, and now we've been concentrating on getting all those rents to market rent, which is the exact same plan we would do here, just like George said.
Exactly. And I hear it all the time, oh, how are you creating value on these A-class deals that you guys are buying? Exactly what we said. It's not much harder than that. There's a couple things here and there that we can add some other income. Internet's an easy one to go in and start doing some profit sharing by supplying the internet, and also smart packages. We're going to be doing some of those in here, but we're going to go through that in a little bit. So here, just going through, I wanted to show you Port of Houston, 225,000 jobs. That's a lot of jobs sitting right there, just a couple miles from the domain. And then you've got Baytown. It's got a bunch of plants, 3.8 thousand jobs, 15,000 in the what they call the industrial district. So I mean, just looking around, you can see there's no shortage in jobs. And once again, these aren't low-paying jobs. I mean, these are high 100,000 a year type jobs. And then here you can kind of just see some of the employers. Within 1 mile, you've got all these major employers, 15,000 jobs supported. 4 miles, you got 225,000 jobs supported with these major employers, and it goes on and on.
And one thing I'll touch on really quickly, on that last slide, LaPorte may not be a market you hear about in the mainstream too often, but this is nowhere near a tertiary market. I mean, this property is 25 minutes away from downtown Houston, so it still thrives off the Houston economy. It's still a very short commute to all the growth that Houston has to offer.
Yeah, I think I've got another slide coming up that shows that. I mean, it's not even a 30-minute drive from Houston. So definitely not, it's in the Houston MSA for sure. So I want to go into rent comparables real quick and show you some proof of concept. So here's the domain of Up here in red, you can see effective rent is about $14.50 per unit. And then we've got the Preserve, which is close to about the same, but then we've got these other two, which is Lenox and Caroline. Lenox being at $16.02 per unit, and then Caroline at $19.10. Now, this is driving pretty much the same users, except it's further from the jobs. So before Domain came around, these were their options. The individuals making these higher salaries, they had to make a commute, a little bit of a commute away from their job to go live somewhere nice. Well, now they've got it right there, you know, quick drive to their job and beautiful place to live in. And here you can kind of see the breakdown of what I just went through. You know, you got the 1910, the 1602 compared to the 1457. You can see these other ones kind of in line where Morgan's is at, but at the same time, look at the age. So, you know, this is a 2010, this is a 2015. We're talking about the 2021, and like I mentioned, A+ product. So market overview, I'm going to quickly go over Houston and then the submarket. I'm sure a lot of you are familiar with Houston and everything it has to offer, but I'll quickly dive into that. And like we've mentioned already, you know, Domain at Morgan's Landing, it's positioned in one of the best suburbans for multifamily around Houston. And mainly because there's not a lot of A-class, like I mentioned, and the fact that you've got those high-paying jobs. So Houston overall, it's a growing city. It's we started buying in Houston in 2019 when not a lot of people were buying in Houston and shying away from it, and we saw that it was undervalued. And then it feels like in 2021, coming off of COVID, everybody figured that out, and the prices started skyrocketing. You know, to us, it was common sense. When your population is growing as much as Houston is, and you've got that many jobs and that many major employers coming to a city, it's going to grow. You know, it had a bad perception at one point with being all about gas, which is not the case anymore. It's pretty spread out. You got a lot of medical districts and all kinds of stuff. And then you had the hurricane, which, you know, there hasn't been major flooding in a while, and there's always, we're not in a flood zone at this property, by the way. But yeah, so I don't want to spend too much time on Houston. I mean, it's, I believe it's the 4th largest city in the US. If you look down here, it's #1 largest decline in year over year for multifamily permits. So this is just showing you that not a lot of new construction coming on board, at least not enough to take on the population growth. Then you got #2 highest demand since the start of the pandemic. It's the #2 highest demand. And then #3 highest demand of, I'm not sure what, because I can't read it.
Might be just a typo.
Yeah, so submarket wise, the Porte, right, is what we're talking about. It's the #1 submarket in the southeast of Houston for smallest construction pipeline. So like I mentioned, not a lot of new construction coming online. It's #3 for overall performance. And then top 20 around Houston, which if you guys are familiar with Houston, there's a ton of submarkets. So this is in the top of those submarkets. And some other highlights here, you got already mentioned the shortage in Class A for sure. Don't want to beat that dead horse, but a lot of demand and a little bit of supply is pretty much what you say, what you're seeing there. A lot of demand, a little bit of supply, so that's always good. And then I was gonna give it to someone else now. Business plan, right?
Yeah, I'll take it from here, George. I'll cover this slide.
Perfect. Drew, a lot of that sources are coming from CoStar and RealPage.
I think we're good. All right, so kind of like we already went over, but our business plan for this property, we do get a lot of questions of, how can you buy an A-class deal? How can you add value to it? How can you increase the NOI? So we'll summarize a couple of those points right here. To start, like kind of we already mentioned, but we're going to gradually increase rents on average about $174 a unit upon lease renewals. So like we already mentioned, but the developer, when they're developing this property, they're in a high interest construction loan. Their main goal is to get this leased up and reach stabilization as quickly as possible, so that one, they can either refinance out of this high interest loan or sell the property, use the proceeds for the next project. So that's where we see the most of the opportunity in this property and these A-class deals. The next one, we are going to normalize expenses as the property has now reached a good form of stabilization. We'll touch on that here in a second, but the expenses are high just from them spending a ton of money on different aspects, getting it to that stabilization point, like we mentioned. So I'll touch on that here in a second as well. The last one is focus on resident retention. I think this is going to be a really critical part of this business plan. And that's just keeping the tenants that we have in there now as happy as they can be. So this is a brand new property with brand new tenants. We want to do everything we can do in order to keep these tenants in there, keep it full, and to have these tenants, renewing the leases. We can do that by sending them a welcome package after acquisition, hosting monthly events, hosting a wine night in the beer garden, and things like that. We do have a $1 million CapEx budget for this property. And again, it's an A-class property, brand new, but there are, several things we feel like we can do to this property to make it even, pop even more. One of those things is installing smart thermostats and smart locks to every unit. This was an idea we thought of actually during due diligence. When I was personally walking the units, I noticed a handful of them already had smart thermostat and smart locks on their units, which shows that, tenants in this demographic, they would enjoy and appreciate that sort of thing. So we think that'll be really popular here as well. Additionally, on that, I toured several of the comps, and these are all other A-class, really nice deals as well. But none of them had smart features in any of their units. So we'll think by doing this, it'll even, set this property apart even more and make this more competitive to the other properties in the area. Aside from that, we're going to restripe the parking lot, power wash the exterior, repaint some of the metal gates out front, and add pergolas to some of the pool areas. Now I'll jump into some of the fun stuff. That's the underwriting analysis. So we're purchasing this property at a little over $73 million, which comes out to roughly $209,000 per door. When you add in our closing costs, acquisition fee, we're looking at a $76 million purchase price. The next table says renovation assumptions, but this is really just our rent increase timing schedule of our underwriting model. So if you look at the bottom, we're projecting a $173 rent increase. We know this isn't going to happen immediately, so we expect this to happen over a period of 25 months, or roughly on average around 14 units per month. So these, again, like we mentioned, these are doing lease renewals. These are when units become available, we're installing the smart packages, and hopefully we'll get it done sooner, but we expect this to take around 25 months for these projected rents to be realized. Moving on to some of our assumptions and organic growth assumptions. Starting at the top here, you can see our year 1 through year 5 average rent on the property. Down below that is our yearly organic growth assumptions. I won't touch on everyone, but you can see we're growing expenses by 2.25% every year. Organic rent growth, 0% for year 1, 3% for 2 and 3, and then a modest 2.5% after that. Pretty similar story for other income. And as you can see to the right, we're still accounting for some form of loss of lease, bad debt, concessions, and vacancy drops to 5%, which does match what we're seeing in this submarket as well. Going on to our other income and expense projections. I won't touch on each individual line item, but you'll see how these compare to the T3 analysis here in a second for other income and RUBS. We broke out best we could for the parking, garages, and this is what we plan on charging for each of those amenities. Internet is going to be a huge revenue driver for this property. They are currently being charged, each tenant is currently being charged $80 a month for their cable and internet. So we're assuming no increase on that. Operating expenses, all of which have been verified by our property management company, who is very active in Houston. Use them on hundreds of doors already and feel really confident in their performance. I'll just touch on real estate taxes, because we all know that's a big make or break for any deal. We actually reached out to 2 different property tax consultants that gave us a year 1 through year 5 breakdown of what the property taxes could be after acquisition. So feel really confident in that number. Texas, so you're going to have franchise taxes, insurance coming in at $865 a door, which is going to be under an umbrella policy with our property management company.
A couple of things that, can you go back a second, Justin? Just want to highlight a couple of points that Justin talked about. So, everybody knows that Texas is absolutely booming, right? And, we got a lot of partners and people bring us deals and, they may come in with, exaggerated, rent growth, right? So I just wanted to highlight that, we're not, although, Texas is experiencing massive rent growth, we're keeping our rent inflation very conservative, 3%, which is really the standard across, what's normal in this business, not the 5, 10, 15% that we've been seeing in some markets. And for the most part, we try to, be very conservative and really do a good job and do due diligence as far as our numbers, right? You heard Justin say that we reached out to a tax consultant to make sure that, the taxes are in line. For those of you that have more experience, that taxes and insurance can kill any deal. So we want to make sure that we have those numbers, solidified and very concrete and not from just one source, but multiple sources before we move forward with any deal. And I know personally within our company, I play the role of, how many times can we kill this deal? Or I want to try to kill this deal multiple times before we say, all right, it's a pass. And I know myself and George bump heads on this a lot, but it makes for a good partnership and for good teamwork, right? One person is pressing on the gas and the other person is trying to say, hey, what about this stuff, right? And it really ends up in a happy medium for us. But when we present these deals for our investors, they've been vetted, tried and true. We've gone through every single thing back and forth. And obviously, if we're, putting up large sums of earnest money and taking the risk on all these deals and coming to present it to our investors, we feel very confident about it. So anyway, just wanted to highlight that. I think that's important when it comes to underwriting and just being conservative in our approach and how we look at these deals, because at the end of the day, when we look at these deals, it's about what's best for the deal and what's best for our investors. If we came in here with exaggerated, projections, people would think we were unrealistic. And if for whatever reason, maybe rent inflation is a little higher, then great. It's only a positive and it's only going to benefit the return. So just kind of want to highlight that as far as a thought process as to how we go about things here at Elevate. And, again, for some of the ones that have maybe not been on any of our presentations or invested in any of our deals, hopefully that gives you a little bit of insight. So anyway, Justin, back to you.
Yeah, awesome points, Eric. It'd be awesome if we can get, 5-10% organic rent growth every year, but definitely not banking on it.
By the way, and as of right now, I'm actually working on getting a lower insurance quote on that 865 a door. I have an insurance agent. We reached out to a couple and they said that they, that's why we were going with our property management's umbrella policy, because it was the cheapest, but we actually came across a guy that says he can get it even cheaper. So that'll help, the bottom line overall. So we'll see if we can get it done.
Awesome. All right, so looking at the rents, we all know in any real estate syndication deal, any value add deal, rents is really like the main driver of the income, the business plan, and what, again, what really makes or breaks the deal. So looking here in the top right, you can see the unit mix, different square footages of the different units, unit makeup, but really pay attention to the current in-place rents. We're at about $14.94 on average for the property, or about $1.61 per square foot. You can see our exact projected rent amounts we want to achieve over the next 25 months here in the very right column. That's coming in at an average of $16.68 or about $1.80 per square foot. Looking at this graph, and move this camera. Looking at this graph below, these are some of the comps we mentioned earlier. And I mean, I personally say, like, you never want to be the most expensive place in any area unless you have like a really good reason to be. But I think, like we've already highlighted, like one of the the many reasons why this is a really premium product in a growing market. So I think it has a lot of good reasons to be one of, if not the most expensive place in the market. So looking at this graph, you can see the other A-class properties we're comparing it to, even after our projected rent increases. We're on the higher spectrum of these other comps. I mean, Caroline is kind of an outlier. If you take that one out, I mean, we're still pretty in line with the other comps. Looking at this unit mix, a lot of the rent increases are going towards the 2- and 3-bedroom units. So looking here at the table in the bottom left, I made this table because you can see our projected pro forma rents to the very right. And from the very latest rent roll we have, these are the highest lease units on these floor plans. So take, for example, the 1-bedroom unit at 710 square feet. As of now, we have 1 or more units leased at $1,380, and we're projecting $1,355 in our pro forma. Same for the floor plan at 805 square feet. Currently now there's 1 or more currently leased at $1,550. And that's right at our pro forma rate. So feel really confident in these projected rents. Again, it's $173 over what they're already achieving now. So with how the growth is currently going with this property, I feel really, really confident in these rents. I will mention as well, Hawthorne at Bay Forest is another recently new developed property, and they are currently in lease up. They were about 65% occupied when I personally toured it. So I can only expect these leases or their rents are going to increase as well. Looking at our capital stack or our sources and uses, we're getting a loan for $52 million. Preferred equity is coming in for 80% of the capital stack. This hasn't been mentioned yet, but we have a joint venture partner that liked the deal so much when we presented it to them. They are funding 80% of the equity needed. This is another really experienced group that is active in Texas and numerous other markets. This has been approved by their underwriting team, their leadership team. They like this deal a lot. I think that's why they're confident that they're putting down 80% of the capital for it. And then Elevate is raising, as you can see, the remaining common equity around $5.1 million. Looking at this sensitivity analysis, you can see we're projecting an exit cap rate in 5 years of 4.25%, which would come out to an LP IRR of 16.4% and a 2.1 equity multiple. You can see the different scenarios if this were to sell at a 4% cap rate. And I mean, nobody knows what's going to happen in 5 years, but I mean, currently right now in Houston, I mean, we're seeing C-class deals trade at low 4% cap rates right now. So this will kind of give you a good look at some different scenarios of what could happen to the projected returns with everything staying the same in the underwriting model. To the very left, you can see the T3 analysis. And any property that's in a lease up, kind of take their financials with a grain of salt, just because the vacancy is going to be higher, the concessions are going to be higher. Like we mentioned earlier, I mean, they're doing everything they can to just get it leased up as quickly as possible. As you can see here, I mean, just take for example, advertising. Their marketing expense is around $200,000 per door, which is insanely high for a property of this size and class. I mean, now that it is stabilized, it is 95% occupied. We have no reason to spend that much on marketing, and we're projecting a pretty, I mean, slightly even on the higher side, $200 a unit a year, which comes out to $70,000, just as an example. So take some of these expenses with a grain of salt. It's not how we feel the property is going to be performing after acquisition. Senior debt, we're getting a 67% loan to cost bridge loan on this deal. This is a 3+1+1, or otherwise known as a 3-year term with 2 1-year extensions. 100% of the CapEx, that $1 million that you see right here, is being funded by the lender as well. And our rate is 415 bips over SOFR. And happy to answer any more questions about the financial analysis after this presentation. And I'll kick it over to Brian to talk about depreciation.
And really good job, Justin. I appreciate that. So some of you guys may or may not know, Justin, before joining Elevate, was a multifamily underwriter for a commercial bridge lender in Indiana. Before that, got his degree in finance from Kelley School of Business. So definitely, you talk about conservative underwriting, we definitely have to have someone on the team that is able to look at numbers like you just saw and, do worst case and best case scenario. So a lot of times these projections are based off those scenarios and those stress tests that Eric mentioned. So you'll see that here in the slides, which we'll make available to you guys. So depreciate besides returns, another reason why we're investing in multifamily real estate is the bonus depreciation cost segregations we're doing. So this property is unique. The land value is actually verified from 2022. So we were able to raise the total depreciation for this one. So for $100,000 investment, you'll see $103,000 in 2022, and then we've got about just over $157,000 spread out for the remaining life of the investment. So great play for some of you higher income earners. So you've invested. What happens after you make that initial investment? We'll be sending you monthly reports on this property, quarterly analysis, distributions. So once you sign up to the investor portal, you'll enter your ACH information. You'll enter your emails. So that's where we will make distributions. That's where we'll communicate property updates to you guys monthly, how the property is performing, really paint a good picture for you and include pictures to anything that we're doing on the property. So those distributions, usually we'll see those, we usually hold back for the first 2 quarters, really get into the property and see how we're performing. And then from there, usually quarterly. Looking at monthly, it's a higher expense to do monthly distribution. So for now, I would say quarterly distributions. Communication, like Eric also touched, but we're available if someone's going to answer your email or phone call just about any time in the world, anytime. So you can try us. All our contact information is on here. So someone on the team is monitoring emails. So how to invest? You guys should have received a link. You'll have a link on this portal to be able to invest. From there, you'll review
I actually just put it in the comments too.
Okay, George has got the link in there right now. So we are working on the PPM. We're finalizing that with our lawyer. So that'll be uploaded to the portal where you'll sign and incorporate yourself into the LLC as a limited partner. And then from there, there'll be funding instructions after you sign through all that. But for now, the PPM documents are not uploaded and the funding instructions are not in there. But we are scheduled for July 15th. So it is a first come, first serve investment. So make sure you can still go in there, which some of you have already done that, made your reservation. So if you've liked our business plan and you see the opportunity in this apartment complex like we do, I would encourage you to go in there and make your reservation. And then from there, that'll reserve your spot. And we'll upload the PPM documents and funding instructions at the end of next week. Right now, we are scheduled for closing July 15th. And we usually like to have that funding in about a week before. But for now, we are taking those commitments. And to paint a picture here, we had 150 signups for this webinar. So if 40% of you all decided you liked the business plan, agreed with some of our underwriting and liked the return on your investment, we would be filled if even under 40% of you guys did decide to make that final commitment. So definitely encourage you, if you feel good about it, to reach out to me if you have any more questions, or we're going to actually take this time to actually open up for any Q&A. I know we were doing some throughout the webinar, but we're going to open it up to some Q&A here, unless these guys have anything else.
Yeah, I just wanted to touch on a couple of deal points that we may have not covered. I think we may have missed, but as far as the closing, I know we have a built-in extension, so we may or may not exercise that. In case you guys are wondering, it's only about 20 days or 17 days away from closing. So just FYI there. Our management company is actually going to be Asset Living. We use Asset Living for a lot of our properties, almost the majority of our portfolio, and do a very good job for us. So they will be managing the asset. As far as from a guarantor perspective, myself and George will be signing the loan, as well as our 80% equity partner will be signing the loan. So we're fully vested in it. And then, Elevate will be putting in 10% of the equity required into the deal, right? Everyone always asks, well, what are you guys putting in? Well, the lender requires we put in 10% always. So, we always invest side by side with all of our investors to make sure that, we are, equally aligned. I think I had one more point, but I think it just left my brain. So maybe it'll come back. So that funding deadline is we're right now, July 10th. Eric mentioned it. We may be exercising extension. So if you, for some reason, have a capital event after that, we can try to make an exception. Just reach out to email me and we'll look at that on a case-by-case basis. If you want to invest, but your funds might be coming in later, let me know and we can try to front that.
There's one question in here. Can you recap how much your company is investing here? So I think Eric just mentioned that it's roughly going to be around 2.5 million that the GPs are investing in the deal. And then as far as the big institutional investor, so they're JV equity, so it's a joint venture. We're going to be partners in the deal, and they're putting roughly around 20 million. So really, as far as LP investors like yourselves, not a lot of room. So I mean, we do see this moving pretty quick.
For sure. There was another, so I'll mark that answer. There was another one. What is the current market cap rate? Market cap rate is from 3.75 to 4% that George mentioned. Properties. Okay. You answered this, George, but I'll answer it here. Property is beautiful. A few questions. When the scheduled closing? Okay, you've gotten hard deposit. Close is scheduled for mid to late July. Deposit has gone hard. We are getting ready to close. We negotiate low basis compared to sales comps in the area and leverage our track record for closing versus purchase price. We don't see any job loss coming from the Bay. It's actually expanding and jobs are growing. We do have a lower leverage debt to hedge against any recession risk. And that is true. You know, we talk about the port. You saw a lot of issues in the supply chain industry. A lot of companies are looking at moving their operations from the Port of California to the Port of Houston. So another great economic impactor there. Let's see. I was
able to pull a couple of questions too, Ryan, if you want me to.
I think some of them kind of disappeared. I'm only seeing like 2 on our end.
Yeah, so if you can go to open and answer. So there's tabs to go to answered and then open.
Yeah, so I mean, I'm answering one right now. I'm typing it out, but I guess I'll go ahead and say it too, which they're just asking is 3% closing costs for the buyer side typical? Is there a breakdown of that? So typically on a bridge loan deal like this, it's anywhere from 3 to 4% is pretty standard. We can definitely send a breakdown if you want to email us at info@elevatecig.com. We can send you that breakdown.
3% is directly from our term sheet too.
Yeah, and then Jennifer's asking about how much is the pref equity partner charging? So it's not a pref equity partner. This is a joint venture partner. So they're going to be true partners on the deal. They're not going to be acting like debt in a sense, which is what pref equity does sometimes. So there's not really a charge per se.
They're all good questions, and I like them as they were coming through. Definitely some experienced investors here. I recognize some of you guys from some of our past deals here.
If someone's asking what's the exit cap rate we're assuming, I think Justin covered that in there.
Exit cap, I believe, was 4.25, right, Justin?
Right.
We did have a question too. One of the attendees was asking regarding the SOFR, 415 bips over SOFR.
Correct.
You can explain exactly what that is for everyone, Justin.
Explain.
They want to know what that means. 415 bips over SOFR.
415 bips is really just 4.15%. It's the interest the lender is charging on the loan. It's how they're making money. SOFR is an index rate that is the commonly used index rate as of recently.
BIP stands for basis points. It's kind of like the multifamily slang lingo we're using.
Yeah.
I see another question here from Maria. Says you mentioned it's a JV with somebody with 20 million. Yes, so they are a general partner with us. The JV is not part of our LP. And our JV partner is, well, so I take that back. Our partner is a general partner, but their fund goes in as an LP investment. And then they are getting an acquisition fee as well. So it's a 2% total acquisition fee. It's 1% on our end and 1% on their end.
It is not in a flood zone. Property is confirmed to not be in a flood zone.
Yeah, and that was part of us in our insurance diligence. We've looked at some properties that are in a flood zone, and the insurance rates are $1,500 plus per door, which is crazy. But yeah, this is not in a flood zone.
Yeah, great questions, everyone. We're excited about this deal, and if you guys have any questions, you can put them there now or reach out to us after. Not sure. I haven't seen any new ones come through.
Actually, I wanted to talk about one point in regards to the debt, because I think everyone's kind of concerned about that now in today's environment. You know, so our lender is actually Angel Oak. It's a lender that we haven't personally used before, and I don't think our partner has either, but came referred, you know, highly referred from other references and whatnot. So, you know, they gave us the best leverage, really, with the best rate in a time where, you know, interest rates are a little higher than what we've been used to for the last couple of years. You know, some may ask, you know, what are you guys doing as far as rate cap? This particular lender and the philosophy here, and this is something that we discussed, you know, in detail with our partner, is that, you know, we didn't want to use any lender that required a rate cap. You know, we feel that right now, you know, although there's been an interest rate and a hike in interest rates, those things are going to level out and come down. And if you know about interest rates and rate caps right now, they are crazy expensive, and it can add a lot of cost to the deal. So we went with Angel Oak because, again, they didn't require a rate cap, and, you know, we feel that, you know, the market will kind of level out, and, you know, we'll be okay with the current debt and the rate that the floating rate that we have. You know, of course, at some point, if things change and our assumptions are wrong, you know, we will look at the rate cap and we can definitely do it, but we didn't want to stress the deal from day one right off the bat. So anyway, it
also helps that our JV equity partner, if they have a fund, an ongoing fund, so worst case, they have no problem stepping in if the recession gets really bad for any reason.
Yeah, our JV equity partner raises anywhere between $20 to $30 million a month. So cash flow and you know, cash management won't be an issue whatsoever on this deal. And obviously, those are, you know, having a strong partner like that helps. And like Justin said, somebody who's willing to write a $20 million check, you know, has confidence, right? So when you decide in putting in your, you know, $75,000 or whatever it is, you know, keep that in mind, because I think that speaks volumes. You know, as to a particular deal and the amount of risk somebody's willing to take alongside their investors. What other questions do we have? Nate, any other ones that we missed?
We had one come in. I think Justin touched on it, but someone was asking, why is the builder actually selling or choosing to sell at this time?
Yeah, I mean, I think that goes back to the developer, you know, not being an operator, and this is what they do.
Another one for, I guess, Justin or anyone. How will you address the fact that the floating rate will eat into investors' payouts? From Jennifer.
We're projecting the exact SOFR curve in our underwriting model.
Yeah, so in our underwriting, we use a model where you can build in the forward curve, which historically the forward curve is like worst case scenario. It barely ever gets followed. So we should be good.
Yeah, and this isn't a deal overall, and most Class A assets aren't deals that, you know, are cash flow heavy. You know, the cash on cash return isn't heavy here, but obviously we are, you know, the exit is really where our play is here, and everybody has a different reason as to why they invest. You know, some people, you know, we've had investors tell us, like, I don't even care if you double my money. I just don't want to pay any more money to the IRS. You know, what's the depreciation like? Some people ask, well, what's the cash on cash? You know, I like the you know, the quarterly or monthly returns. Some people, you know, want the 2x returns. Some people want all of it, right? So it all just depends on what your needs are and what you're looking for as an investor. And if it's not this deal, you know, definitely there'll be other deals down the line. But, you know, we feel really great about this deal. I mean, every Class A deal we've done so far in our experience has been, you know, a winner for us, and you know, especially in these growing markets. So again, excited about this one.